All right, back for more Aussie real estate action. If you've been tuning in to our deep dives, you know we've been uncovering some pretty incredible investment strategies.
Some real gems. Yeah.
And, of course, we've explored some seriously hot property hotspots down under.
Absolutely sizzling markets.
But, something we hear a lot is, how do I actually make this happen? Like, how do we finance these Aussie real estate dreams? Especially when you hear all the time that you need a 20% deposit.
Yeah, that's the big one, right? 20%. It can feel like a massive hurdle. Like, where do you even begin to save that much?
Right. Like, is that even possible?
Yeah.
But here's a little secret, that 20% isn't always the be-all, end-all.
Not at all. There are absolutely ways to break into the market without having a mountain of cash just sitting around.
So no need to panic if you haven't got that 20% saved up.
Don't stress. There are options, my friend.
Yeah.
And the cool thing is, it's not a one-size-fits-all situation.
Okay, I am intrigued. So let's break down some of these options. First up, we've got low deposit loans. What's the deal with those?
Well, low deposit loans are pretty much what they sound like.
Uh-huh.
Instead of needing that big 20% down payment, you might only need, say, 5% or 10%.
Much more manageable.
Way more accessible, right. But there is a little trade-off. You'll probably need what's called lender's mortgage insurance, or LMI for short.
LMI.
It's basically an insurance policy for the lender. So in the unfortunate event that you can't keep up with your repayments, the LMI kicks in and covers them.
Gotcha. So it's protecting the lender, but how does LMI affect me as the borrower?
Well, you're essentially paying a bit extra to offset the lender's risk, so it does add to your overall cost. But there's a flip side to this. LMI can actually be a strategic tool. Think about it. It lets you jump into the market sooner, potentially letting you ride that wave of property value growth over time.
I see. So that extra cost might be worth it in the long run if the property value skyrockets.
Precisely. And that's why it's so important to crunch the numbers, really look at the long game, compare different LMI providers too, because the cost can really vary. Weigh that against the potential gains you could make by being in the market earlier. Could be a really savvy move.
It's like you're paying a little extra to unlock a door that might have been closed to you otherwise.
Exactly.
Okay, cool. So let's say you've looked into LMI and you're still exploring other options. What about, tapping into the bank of mom and dad?
Good old guarantor loans. That's where family steps in to lend a helping hand, literally.
Right.
Usually it's a parent who uses their own property as extra security. They basically vouch for you to the lender.
So say I'm struggling to scrape together even that 5% or 10% for a low deposit loan. A guarantor could make it possible to buy with even less upfront.
Yeah, potentially. And the beauty is it can also help you sidestep LMI entirely. But, and this is a big but, we can't ignore the risks here. A guarantor loan is a serious commitment, and it can put a real strain on family dynamics if things don't go as planned.
Oh, absolutely. Last thing we want is family drama over real estate.
Definitely not.
So open and honest communication is key here.
100%.
Everyone involved needs to be super clear on the terms, the responsibilities, what happens if things go south. Everything needs to be on the table.
Absolutely. And it's also worth exploring other options, like a family trust. They can provide a bit more structure and legal protection for everyone involved.
Okay, good to know. So we've talked about banks, we've talked about family, but what if you're looking for something a bit more, shall we say, unconventional? What about private lending?
Now private lending is a whole other ballgame. You're borrowing from individuals, could be family, could be friends, rather than a traditional bank or lender.
Interesting.
It can be a much more personalized experience, and the approval process is often much faster.
That flexibility sounds pretty tempting, but what are the downsides? What should people watch out for?
Well, for starters, interest rates can be a bit higher compared to those traditional bank loans. And, of course, there are some legal things to be mindful of. You absolutely need a solid agreement in place, something that protects all parties involved. Really got to dot your I's and cross your T's.
So it sounds like private lending might be a good fit for someone who's comfortable with a bit more risk, someone who needs to move quickly, but definitely not something to jump into without doing your homework first.
Exactly. Vet any potential lender thoroughly. Make sure everything is in writing, and it's always wise to chat with some legal eagles to ensure you're fully covered.
Solid advice. So it seems like the takeaway here is that financing your Aussie real estate dreams doesn't have to fit a cookie-cutter mold.
Not at all. There are options for every situation.
Awesome.
And as you navigate these options, remember to keep it real. Think about your financial situation, how much risk you're comfortable with, and where you see yourself in the long run.
Great point.
Do your research, talk to the experts, and most importantly, don't be afraid to think outside the box.
Love it. Couldn't have said it better myself. Thanks for joining us for another deep dive into Australian real estate. We'll be back next week to mention a teaser topic for the next episode related to Australian real estate. Until then.